We've assembled a Taking Stock think tank in order to help us understand what this means for investors and for the economy. We have Mark Grant, Managing Director, Southwest Securities. He's got 4 decades of experience on Wall Street. We won't hold that against him. Cliff Noreen, he is the president of Babson Capital. He stewards over $135 billion worth of client money. And Mike Green, he's the chief executive of Tenex Capital Management. He specializes in restructuring troubled firms. All right, Mike Green, then in this case, I'm coming to you first. Restructuring the U.S. economy. Is it that we are just highly leveraged and we're working off huge amounts of debt? Is that what the president's really addressing?
Well, yes, and then other things. We are obviously highly leveraged, as the other 2 gentlemen will point out. But we also have too much capacity, as you know, in many industrial sectors in the U.S. And our economy is based on growth. Everybody wants growth to create jobs. But when there's already too much capacity, it's hard to stimulate growth simply by lowering interest rates and giving tax breaks. The president's obviously talking about something different now, eliminating some of the tax loopholes and tax breaks. But yes, we need restructuring, we need resizing, we need to have our capacity a little bit more aligned to our demand. That's tough medicine for many people, but there are not many options that I can see.
Deleveraging and capacity, Cliff, is that the issue right now in the economy? Because when you talk about tax increases and lower government spending, that's about the budget. That doesn't seem to focus necessarily on the economy issues.
The economy has several real problems in it. We have too much debt to begin with. We have $14 trillion of debt. Homeowners are reeling. We have about 12 million homeowners who have negative equity, and that's really hurting the economy. Over the last 10 recessions, over the last 50 years, the government would simply lower interest rates, and that would lead housing. Housing accounts for an average of 4.5% of GDP. It was at 6% in 2006 and 7. Now it's at 2%. So that formula is not working. And that's why we're in the state we're in today. That's one of the major reasons.
Mark Grant, bring in the issue of the Greek debt crisis and what this means for the United States, because we're all connected globally. And you've been talking about people going into U.S. Treasuries saying that's the safety trade. Go there because there's too much risk.
That's right.
We've got too many problems all at the same time.
Yeah, the real problem is people don't understand Greece correctly. They look at it and they say, oh, it's this very small country and it's a little part of the European Union. And that's true. But if you add up the total debt of Greece, including municipal debt, the government debt, the corporate debt, the sovereign bank debt, you're looking at $1.1 trillion worth of debt, and they're an inch away from defaulting. The country's bankrupt, and either it's going to be the IMF and the European Union that are going to give them more money or not, depending upon, I suppose, what they think in Berlin in the final estimation.
Cliff, the idea that if Greece defaults, this will have an effect on U.S. investors. Are U.S. investors insulated from what's happening overseas?
Well, U.S. companies and U.S. businesses do have a lot of business they do in Europe, which is going to be affected by Greece and these other peripheral countries, these PIGS countries that have way too much debt. We have Portugal, Italy, Ireland, Greece, and Spain all in a predicament. Greece is obviously the worst. Greece's 2-year yields today were 61%. Their 10-year yields were 23%. So obviously the market thinks there's going to be a default there. And Greece is actually a pretty small country. It only has 10.8 million people. It's about 0.2% of GDP. But if Greece defaults, what's going to happen with these other countries? And there's a lot of cross-ownership of bonds between all these countries in Europe, which could be a major problem.
Mike Green, you're an expert when it comes to turning around companies. Do people typically have to take haircuts, even bondholders?
Oh, I think they do. I mean, maybe I don't have the most, maybe my opinion's a little biased, but yeah, everyone needs to take a little bit of pain. Everybody has to take the haircut, especially companies that are trying to grow. They need to realize that they can't just keep stealing market share from each other when markets aren't growing. So yeah, I'm a proponent of people trying to avoid a default. I would not like to see a default, obviously. If a consensual solution could be worked out, for my constituent base, American exporters would have a market to continue to export to. If there is a default in Greece or there is some calamity in the European capital structure, that makes U.S. products potentially harder to buy there as they continue to devalue overseas, and we need those export markets. So I think the U.S. manufacturers, U.S. companies really need to look hard at themselves and realize that you cannot continue to expand to drive your public stock price high. You need to tighten a little bit. You need to pull in a little bit. I'm sure the president doesn't want to hear those things when he wants to expand, but it's a very difficult environment right now for a U.S. producer.
Well, we've even noted over the weekend there was a news report about pharmaceutical companies refusing to sell their pharmaceuticals into Greece because they're not getting paid by the hospitals. Right. Mark Grant, we were just showing a Bloomberg fast fact that of an 11 million population in Greece, 1 million of those people are employed by the Greek government. The Greek government came out today and said that under the current austerity plan that they are trying to implement, they would have to lay off another 20,000 workers. Do you think this is politically doable?
Barely. And the only reason I think it might be politically doable is because these people are just trying to live on the dole as long as they can. Should it be politically doable? Absolutely not. The problem with the periphery countries, Greece, Italy, Portugal, I call them the winking, blinking, and nodding countries, because they say, oh, we're going to do this, and they promise this, and they deliver nothing. So they promise it now, the next quarter, the next month. When you get the data, nothing.
Nothing. Cliff, if that nothing comes to fruition, what happens to investors here? Where should they be putting their money? What are the risks?
Well, the risks are obviously that Europe's going to slow down, which is going to impact U.S. corporations, and that's what the stock market's telling us. That's why the stock market is trading off. The stock market is trading at a very reasonable value today. We're at about 13 times trailing S&P 500 earnings, which is well below the average of 16.4 times. But investors are nervous that these macro risks are going to impact European companies and then filter out all throughout the world.
And do you think that that's going to happen? Are companies prepared for this?
I think U.S. corporations are doing extremely well. They have record balances of cash. They have $2 trillion in cash. They can borrow very cheaply. Last week, Intel and Hewlett-Packard borrowed $5 billion each at very low rates. They're using this capital to buy other companies, to buy stock back, to increase dividends. They're focusing on return on equity, and they're maximizing return on equity. On that basis, stocks are cheap, but then you have these risks out there that are overhanging the market.
Mike Green, return on equity, is that the mantra for corporations right now? Because that would explain a lot about why companies are not bothering to hire, or indeed not bothering to establish new factories.
Well, obviously, it's an important metric, but I think the examples we just heard, those are the top-end, strong, multinational, good balance sheet.
Like Intel, Hewlett-Packard being able to access the capital markets.
Right, those companies are not the ones that I'm really referring to. I mean, I think they can continue to operate, to produce cash, to cut costs. They have a very large base on which to work with. Companies that are much below that, I would say $500 million to $100 million. There's many, many companies that are in that situation where access to capital is not so easy, Pimm. And also, it's going to be more difficult for them to continue to produce the profits that the large multinational companies have produced simply by tightening their belts and cutting costs. The large companies are doing what they should do. They have the balance sheet to do that. They don't have asset-based lenders chasing them for money. But most of the U.S. companies cannot do that, which is where the real pain is. People that have overextended themselves for the last 5 years. And I think, that's where there could be opportunity and risk. If you take a long-term view of some of these companies, I think they're trading at much cheaper levels than some of the big companies we look at. If you're ready to wait it out for a long time, maybe dip into a little bit below or above the equities, into some of their debt, their secured debt, and maybe even their bonds, which are trading at discounts. If you have a tough stomach, those things could come back when the economy in the U.S. comes back over the long run. But I think the multinationals have a nothing's easy, but a different problem set than the smaller, less than $500 million companies have.
Why do I think that Mark Grant does not have a tough stomach for all of these equities? You really think that people ought to be in the highest quality corporates as well as U.S. Treasuries, because you're concerned about the risks, not only in Europe, but what that mean for the United States?
Well, Pimm, as you know, you get my commentary, and I try to warn people when I think there's great risk, and I think there's great risk now. We're going to be in a financial crisis similar to the American financial crisis with Lehman. I think when this happens, to reference something Mike just said, you go to the top of the capital structure. You want to be in senior debt of highly rated corporations. You want to be in treasuries. You want to be out of equities, out of preferred stocks, and you need to be in a place to preserve your capital, because things could get very ugly because of Europe.
Cliff, Noreen, the Treasury Secretary Timothy Geithner, he was speaking to Bloomberg News' Juliana Goldman today. He's made 2 trips to Europe to try to convince the Europeans that it's about growth. It's not about austerity. You think they're going to come around to his way of thinking?
That's a good question, Pimm. Europe has its own issues, and I think they're just trying to stabilize their issues as opposed to try to grow. They are trying to get all these issues behind them. They have some issues with their banking system. The banks are undercapitalized also. They have a lot of issues to deal with besides growth, and I think they need to stabilize their financial system, and that's what the world's concerned about.
I think that's probably a little bit what Timothy Geithner was saying. He was using just those diplomatic words. Indeed. Mark Grant, do you think that it's going to succeed? Do you think that it's possible that we'll get some American-style growth policies in Europe? No, I don't think it's possible at all. As a matter of fact, the finance ministers basically told our Secretary of the Treasury to take a hike, to put it bluntly. He made the suggestions, and they said no, all they were interested in is on austerity, all they're interested in is cutting back, and of course what they haven't realized or taken stock of is that this just pushes down the economies even more and puts everybody in a deeper recession. Indeed, there are some estimates that the Greek debt repayment schedule is being pushed out to 2041. Cliff, Noreen, tell me about where there are some opportunities for U.S. investors. If they can deal with the potential problems in Europe, are there some bargains in the U.S. market?
I believe so. The U.S. loan market has sold off significantly in the last 2 months. Starting in July, when the Fed announced they're going to keep rates lower for a longer period of time, loans are priced off of LIBOR, and they do have a little bit of a lower current yield. And investors took that as a message that loans are going to have a lower yield for a longer period of time. They sold loans. Loans now are trading at a higher yield than high yield bonds. It's only about 10 or 20 basis points. But
senior loans. These are senior loans of U.S. corporations. Senior secured lending.
Also, the other reason is because the CLO market has shrunk in size, and they were much bigger buyers of loans historically. They haven't been. So you've had redemptions from mutual funds, and you've had CLOs be a smaller presence in the market. And that's resulted in loans now being at a slightly higher yield than high yield bonds, which has never happened before.
So how do you access this? How do you invest in order to take advantage of what you might just consider to be depressed prices for senior secured loans of companies?
Retail investors can invest through loan mutual funds or loan closed-end funds, and those would either trade at a premium or discount. I look today, most of them are trading at discounts. So you're getting 7 to 9% current yield. You're senior secured above the high yield bonds, and most senior in the capital structure, as Mark Grant says he likes in investment grade. So it's a very similar strategy for higher risk investors, but you're getting paid very well today.
All right, but that's higher up in the capital structure, obviously, than just buying the shares of the company.
Obviously, yes.
Mike Green, what are your thoughts? Do you think that senior secured loans are inexpensive now?
Well, senior secured loans are always safer than the other securities we've been talking about. I've been looking at, for our investors and the kind of companies we're looking at, they're probably trading at a higher yield. These are companies that need to be restructured. But yeah, I think relatively speaking, the higher the quality of the company, the less you're making, but the less risk. But I would tend to agree with Cliff that in a time where you're worried about safety, you want a little bit of cash pay, a little bit of yield, buy it at a discount to face, and get a little bump in the yield that you're going to have. So I would agree with that.
Now, you said that there are sort of availability of these kinds of loans.
Well, for people, I'm not sure if I'm not sure if I would recommend to a retail investor to start buying senior secured loans that are trading at 70 or 60 cents to the dollar. But a 5% loan trading at 50 cents gives you a 10% yield. It depends. I would not recommend that for retail investors. But as you know, we buy companies that are sometimes operationally and balance sheet challenged, and that's our job to fix those companies and fix those loans back to something that is a more reasonable return for investors. So,
in having those conversations with the corporate managements now, are they realistic about how quickly they need to restructure and what they've got to do to get back on the path of growth?
Pimm, that's a great question. Compared to 2 years ago, it's night and day. People are really afraid of what happened 2 years ago when they weren't prepared, and it's the old extend to amend to pretend, as we've talked about before. People will still do it if they can get away with it, but most managers I speak with, they're aware that the unthinkable can happen again, and they're trying to protect themselves and prepare themselves and not wait to the last minute to restructure their debt. They're trying to husband their cash. They're doing things that are not helping us create more jobs, which the country needs. But people, I think, are much more pragmatic and realistic about the situation that can occur and how quickly it can occur if you don't have the cash resources or the liquidity available for loans that have short-term maturities.
Well, Mark, that comes into really what you were saying, because the idea being that investors and companies are concerned about the unthinkable, and you really believe the unthinkable will not just be the unthinkable, it'll become the reality.
That's correct. I think that we're right on the verge of a recession in the United States, and a lot of it's going to be caused by Europe. It's not an outlier anymore. It's not some black swan event floating around in the future, and a lot of companies, a lot of people that I do business with, the very large money managers, are getting prepared. They're restructuring their portfolio. They're looking at different asset classes to get prepared for this, and I think that's 100% the correct strategy.
Cliff, short-term money right now. When you see things like commercial paper markets in the United States, they've never really come back the way they were prior to the financial crisis of 2008. Companies husbanding, keeping a lot of the cash on their balance sheet. Do you think that that's a permanent feature of corporate America?
I think corporations are concerned now about their cash. For our clients, we sold all of our European commercial paper in the last few months because we were concerned about the banks over there and what may happen. So we are concerned, and that's what our strategy was.
And so what about for short-term paper? It goes to U.S. Treasuries?
Primarily.
And do you think that that is going to be a long-term bet because the rates are going to stay low for a while?
You can buy U.S. corporations, but that U.S. corporation non-financial is what we're focusing on. And the yields just get smaller and smaller. It's a very difficult business now for money managers because you're subsidizing the low yield. You're eating your expenses, essentially.
All right, we're going to leave it there, gentlemen, but I want to thank you very much. Cliff, Noreen joining us from Babson Capital, $135 billion under management. Mike Green, Tenex Capital Partners, and also Mark Grant, Managing Director, Southwest Securities.